international tax at AJ&W. Our main office is in Atlanta, in Georgia. So just so you know, Cheryl works with me. We're not from San Francisco, but we do have a fair amount of clients here in California, and like to come here, right? Like tonight. I hope we're going to be invited back with this beautiful view. So we work remotely with most of our clients, but as I said, we are here every once in a while. We've done presentations here in San Francisco before, and so we hope we come back. For my background, I'm from Germany originally, born, raised, went to university in the southern part of Germany, Badischen, and moved to New York after I graduated and to get my CPA exam and then go back to to Germany and work there. The CPA worked out, but I didn't go back and actually moved to Atlanta. How things happen, I guess, stories like that, probably all of you have as well. And so I work in Atlanta. As I said, I work for AJ&W. I joined them 5 years ago, and work mostly or almost exclusively with German firms and individuals that do business in the United States. German individuals that work for my corporate clients or that invest in the United States. And with that, work a lot with Joerg, who covers the German side of the taxes, and I cover the US taxes. And so with me being there, we started building a practice which we call the global mobility practice. So that means we work with individuals that move, a lot of them around the world really. The United States is just one of the stations where they've lived, and that's how Cheryl has joined us recently. And Cheryl's going to introduce herself.
Hi, I'm Cheryl Leydon. As Kristin said, I joined AJ&W earlier this year, I think in February. I have about 25 years worth of experience working with individuals working around the world, primarily employees of companies that have been relocated. But since I've joined AJ&W, we've worked with a lot of individuals who are coming into the U.S. With investments and those sorts of issues. I actually grew up in Mississippi, which probably some of you think is a foreign country, but ended up in Atlanta.
We think that too, by the way, Atlanta.
Yeah, exactly. And I know I've met many of you, but hopefully I can meet more of you this evening.
Want to reintroduce yourself here?
So let's say, my name is Joerg Kemkes. I'm a partner with Rueter and Partner for more than 18 years already. Our main office is in Munich, Germany, and we are 7 partners and about 100 employees, and we have an office here in San Francisco because our biggest client base is the Bay Area, the Silicon Valley, historically, so we have most of our clients here, and our core businesses help American companies going to Germany, so we help them with their accounting, payroll, HR service, and everything that's necessary to start an entity, run an entity, and grow it there. And so our clients really appreciate that we have an office here now in the same time zone. But we also do individual returns together with Kristin and her colleague. So we cover the German side, so that means our work is complementary.
Okay, you can all hear me with my microphone here. My name is Greg Wald. I'm a partner here at Squire, Patton, Boggs. We're a law firm. I guess my closest, most immediate connection with Germany would probably be my name. It was the last name. I've been with Squire, Patton, Boggs, going close to 15 years, 16 years. I've been in the Bay Area probably about 17, 18 years these days, I count. Prior to that, I was in South Florida and also lived in Ohio and a few other places throughout the U.S. So with that, I'm going to jump right in, and we're going to, like Joerg explained earlier, just going to touch on some basic points of immigration and a little bit of a crossover between where immigration and taxation meet. Sometimes the rules, the laws, at least on the U.S. side of immigration and taxation, are in sync, and sometimes they're in conflict. One thing that they do share, I believe, is that they're never straightforward, and they're definitely complicated given the circumstances. This is just an outline of kind of what we're going to cover. And like I said, immigration starts with at least getting you here first. So we're going to talk about, at least on the immigration side, entering And again, it's one thing to enter the United States in a temporary basis versus a permanent basis. I will say that our immigration laws are a bit presumptuous and stuck up because in the law is immigrant intent. Meaning when you get off the boat, get off the plane, the law presumes that you want to stay here forever, regardless of what your intention is. And the individual coming to the United States or applying for a visa has the burden under our laws to prove otherwise. So it is a bit presumptuous. We have different visas that are considered purely temporary, what they call pure non-immigrant visas. Others that are immigrant visas, basically a visa that leads to a green card, and then something in between. Certain visas, like an H-1B or an L, that allows you to have this dual intent. Maybe you're here temporarily, maybe you want to stay permanently. The E-visa, which is based on treaty trader, is kind of quasi-dual intent. It's not, somewhere in between the two. This is just a quick summary of some of the agencies that in the immigration world we deal with on an everyday basis. Department of Homeland Security has got three components. When you deboard a boat or a plane, the first people you get to meet typically are the lovely individuals that work for Customs and Border Protection at the airport. The folks you don't want to meet are the people that work for Immigration and Customs Enforcement, ICE. They're the ones that are in charge of deporting people. They also enforce things like immigration compliance, immigration verification rules. Then there's Citizenship and Immigration Services. That's the branch that gives benefits. So if you're applying for a green card, applying for citizenship, you're going to go with in front of the Department of State. They run our embassies and consulates abroad. And Department of Labor, their mission to pretty much put up a hurdle or a roadblock as far as individuals are concerned emigrating to the United States. You'll find that in that kind of scenario written into laws in many countries, including Germany. That usually there's a labor department that is there to protect the U.S. or the domestic workforce. So, questions that we ask, or our clients ask every day: do I need a visa to come here? As probably many of you know, if you're a national of certain countries like Germany, other European countries, Japan, you can visit the United States under a visa waiver program. A visa is not required. The visits are basically limited to tourism or a brief business visit, but you cannot engage in employment or business activities even if you're allowed to stay here for 90 days, or if you have a B1 visitor visa that allows you to stay for up to 6 months. Your activities are limited. Very quick overview of kind of what we call the alphabet soup of the different visas that an individual might obtain. As I stated before, the B1, that's your business visitor. Most European, German nationals don't tend to obtain an actual visa for business because they've got the ability to just come over for 90 days or less. In fact, sometimes when individuals from visa waiver countries apply for a business visitor visa, they raise suspicion at the consulates or embassies. Well, why do you need this when you can come over with your passport and stay for 90 days? Oh, you need to stay more than 90 days? Why? What are you going to do? So it raises issues. E-visa, based on treaty between the United States and various countries. We have a treaty with Germany. E1 is based on trade. A company that is trading between Germany and the United States can qualify for E1 for the owners and or the employees. The thing about the E-visa is the employee nationality must match the nationality of the company. So if you're a majority German-owned company and you want to send German national employees over to the United States, you can utilize the E-visa. But if you're a German-owned company that happens to employ French nationals, they're not going to qualify for the E-visa. They would have to come over on a different visa, possibly the L1 visa, the intercompany transfer visa. Other well-known professional visas are the H-1B. It's considered the specialty occupation visa. The majority of, here in the Silicon Valley area, the majority of engineers coming over, let's say from anywhere in the world, typically are using the H-1B visas. We have a quota of H-1B visas, 65,000 plus 20,000 for those that have an advanced degree from a U.S. university. In the last 5+ years, that quota has been exhausted in a matter of days. So we have a lottery system where on April 1st, the visa application process opens for H-1Bs, and companies rush in and all submit applications. Last year, there was close to 260,000 applications submitted for 85,000 slots. So there was about a 34% chance of getting selected. Same thing the year before. Again, this traces typically with the economy. We've been trying to expand our H-1B visa count for many, many years, but I don't know if you've noticed, but immigration is a little bit of a political hot issue these days, and pretty much has been for many, many years. And the expansion of the H-1B visa quota is kind of lost in the politics of immigration. Other visas, I just mentioned here, TN visa, that's only applicable for nationals of Canada and Mexico. It's based on the NAFTA treaty. You can see how long we have the NAFTA treaty. There's the O visa, which is individuals of extraordinary ability, P visa, which are typically professional athletes. We have other specific free trade visas for Chile, Singapore, and Australia. And then we have trainee and student visas. I will mention that the J visa and the F visa, so J for trainee and student visa F1, are FICA exempt. So there are certain individuals, based on circumstances related to their country, whether we have a totalization agreement, that might be FICA exempt on some of these other visas. And my co-panelists might touch upon that. But when it comes to the J visa and the F visa, and then there's the M visa, which is a vocational visa, pretty much any national from any country is considered exempt from our FICA if they have that visa. The very quick overview. One can get a green card in the United States a few different ways. Through family relationship is one. Through employer sponsorship is another, and through what they call things like a special immigrant. We have designated certain individuals, let's say, that are helping our military abroad during certain conflicts, qualify for special visas. We have exceptions for battered spouses that qualify for special immigrant visas. We also have the diversity visa lottery, which includes certain nationalities that can literally apply, and if they win the lottery, they can immigrate to the United States, get a green card. What I spend the majority of my day dealing with is immigration or green cards based on employment sponsorship. And there's different categories based on an individual's qualifications and the nature of the job. And these are listed right here. The last one, EB-5, employment creation, that, I don't know if you're familiar, that's the $1 million investor visa. EB-5 can also get that visa through investment of $500,000. Those threshold amounts are likely to change as soon as Congress gets around to actually passing an immigration reform law that's pretty much already been drafted, that the threshold investment levels for those visas are going to go up. This is the very straightforward, simple way that one would get go through the immigration process through employer sponsorship, and this is assuming that you have to go through the labor certification test through our Department of Labor. If you're a transferee, let's say an executive or manager that was transferred by your company to the United States to work for, let's say, a related entity here, you would most likely be able to skip step 1, the labor certification process, and go right to step 2 and 3. Step 3 gives you the option to either adjust your status here in the United States while you're here living, working in another status, or you can go through the process abroad. Now, many, let's say, e-visa holders that we work on behalf of might choose to do the process on the far right so they can maintain and continue working on their e-visa while they're in the United States, and then they would finalize their green card process, let's say at a consulate or embassy abroad. It doesn't necessarily take much longer to go that route, and sometimes it's more convenient because it's less disruptive when you go into step 3 for travel and other related work authorization issues. So I just summarized that. Just to give you an idea, again, nationals from most European countries, including Germany, don't necessarily have the same kind of weight for a green card than nationals, specifically, not nationals, but people born, I should say, in mainland China or India. Again, we have a significant immigrant visa backlog, a significant green card backlog, and that's because the law is structured such that if any one nationality takes a certain percentage of the green card pie, so to speak, a queue forms up. It's not so much that the law says we're going to keep folks from China and India out, but it's just based on immigrant flows. So because more individuals are applying from those countries, there's a longer wait. The other thing I want to talk about is for those that have a green card, even though you've gone through the process, you've got the green card, it's valid for 10 years for most, and you can renew it pretty much straightforward. There are ways that one could lose their green card. You could be convicted of a major crime that would make you deportable. You could lose your green card that way. The most common way that individuals might lose their green card is by not maintaining their presence in the United States, spending, let's first off, more than 6 months out of the United States at any given one time. That's a rebuttable presumption of abandoning your green card status. If you go over a year, that is no longer a rebuttable presumption. It doesn't mean that all is lost. There's other factors that go into play, but also factors that go toward maintaining your intent to be a permanent resident include paying taxes, not just filing a tax return, but filing a tax return as a tax resident. So for instance, if you're stationed abroad for, let's say, a short period of time, maybe the company you're working for wants to send you outside for 3 or 4 years, there's ways to maintain your status here in the United States without losing your green card status. But you will have to pay or file your tax return as a resident. If you take advantage of non-resident filing, that would potentially impact your ability to maintain your lawful permanent resident status. The other thing that you would definitely need to do is to apply for what they call a Reentry Permit, which allows you to spend up to 2 years absent from the United States. You'll have to renew that Reentry Permit every 2 years, or at some point the government will actually limit that Reentry Permit to 1 year. And you still have to maintain the other factors. You still have to show that you have the ultimate intent to return and reside in the United States, but the Reentry Permit at least excuses extended absences. Now, the next two slides, and then I'll hand it over to my colleagues, touch upon preserving German citizenship when one acquires citizenship of another country. And I'm not even going to attempt to pronounce the document that one...
Beibehaltungsgenehmigung.
But these are the requirements on these next two slides that one must go through. And you know, when I'm talking to Joerg in preparation for this presentation, you know, this issue came up, and he has a great story. I don't know if you want me to. I'm not going to necessarily tell still the whole story, but the point is that just because you acquire citizenship, or when you acquire citizenship from another country, you shouldn't assume that if your German passport, per se, is still valid, that you're necessarily maintaining your German citizenship. You have to go through specific actions as are outlined in these next two slides. And I will tell you that I had our colleagues in our Berlin and Frankfurt office help me put this together, so if any questions come up, I know that they are very well versed in going through this process. And with this, I'm going to hand it over to my colleagues. Would you like? Yes.
So let's discuss why are we having this presentation, and let's say what is the reason. So I think the tax laws itself, whether we talk about Germany or the US, are complicated by themselves. And why do we have double taxation agreements? Double taxation agreement literally means that you try to avoid double taxation, or that you try to prevent white income. That means your income should at least be taxed at some point. So, and one of the biggest differences between...
Okay. Yeah, I think you might have to come closer.
So, and one of the big things you have to understand is that the United States and Germany have a totally different tax system. So, in Germany, the right to tax an individual is simply based on the place of residence where someone is living. Germany doesn't care about citizenship or any other thing. Do you live in Germany? Do you have a permanent residence there? Or is this your primary place where you live? Then you're going to be taxed in Germany. Whereas the US says, well, we don't care what your citizenship is when you're an American, or when you're an American, you're going to be taxed no matter where you live. And this then might then coincide, let's say conflict with other countries that might have a different system. So this is one of the first major differences. So, and then we will have to decide, due to this double taxation agreement, which country is going to be taxed, which is going to be, has the right to tax, what's a taxable affair, what is the personal tax liability, and on what kind of income is the tax going to be applied, and how is the base for this income going to be calculated. So we can touch this later. For example, everybody knows about the 183-day rule. In Germany it's very easy. You count from 1 to 183 within 1 year. That's easy. But Kristin or Cheryl, maybe you can explain how the 183 days are being calculated in the US.
Right, in the United States, you're a resident not just based on the number of days that you spend in the United States in a certain year, but you also count 1/3 of the year before and 1/6 of the 2 years earlier, prior year. So it's really a sliding scale. So just because I know a lot of people are counting the days and they have very good calendars on how many days they spend, but just because you only spend, 180 days in the United States in the year 2016 doesn't mean that you're not a resident. So we're going to talk about some examples later and showing that there's one exception, to that general rule, but generally you are a resident if you have been here 183 days over the last 3 years.
So, and then please bear this in mind, both countries talk about 183 days, but it means something totally different. So, now let's start about income tax when it comes to employee relocation. I think maybe one of the most important topics. So we got an income, let's say an example here. So single Hans works for a German company in San Francisco for 4 months. The employer does not have a permanent establishment. He lives in a hotel during his stay. His annual salary is 120,000 euros. He has no other income. I think that's easy for warming up. So he's still fully unlimited tax liable in Germany because he keeps his apartment. He does not stay longer than 183 days, according to both countries' calculation. And his salary is going to be paid from a German company, not from a US employer. Would you like to add to this, Kristin?
Right, it's actually on the next slide if you want to continue on. So the US answer is that, yes, he's not, if somebody spends here less than 183 days, for example, in the year 2016, and does not work for for United States company or the permanent establishment of a German company here, and the salary is not charged to one of a US entity, then that's the one treaty exception. That means, you may be here 183 days, but you would not be considered a resident or a non-resident of the United States and would not pay taxes. Or you can take a treaty position not to pay taxes in the United States at all, but you pay taxes in Germany only. So that's important for people that also maybe are in charge of that in a company here, not just if that's your individual case. So that's one of the important treaty exceptions that many people are not aware of.
So now we have a little bit of a variation. So Single Hans works now for a US subsidiary of a German company in San Francisco for several years. Of course, he gives up his residence in Germany. His annual salary is 120,000 euros, no further income. So due to the fact that he gives up his flat, he has changed his center of his life to the US. So this then means he's in the US taxable and not in Germany anymore. So, and then now let's say he is married and he works for a German enterprise in San Francisco for several years, but his family and his, let's say, social connections still stay in Germany. So it means he works here, but his closer ties are still in Germany. So you might elaborate on this. He might claim that he does not have no intention to live here, to stay here, and then he might still, let's say, get away with his just paying taxes in Germany.
Correct. So if somebody lives here in and even for a longer period of time under certain circumstances, when you can show that you still have your, I want to say, longer with a longer perspective, your center of interest is in Germany, you may claim that you're non-resident here in the United States and still pay taxes here on your US source income, but not pay taxes on the rest of your income if you still have income abroad, if that may be rental income, dividend, interest. So that's one of the big concepts, so to say, that if you live in the United States and you're treated like an American, generally you would be taxed on your worldwide income, right? That means on anything that you earn even outside of the United States. But that would be one of the exemptions that we can take on the tax treaty, that if you still have a home in Germany and closer ties to Germany than to the United States, that you would only be taxed with your US source income.
Yeah, and US source income is defined a little bit differently depending on the type of income that you have. If you have wages, the income is not who pays the income to you, it's based on where you're working. So US source income can be paid from Germany, but based on your work days here, it would be considered US source. Other types of income, if your capital gains are taxed where you're a resident. So for most types, there are some types that don't qualify, but for most types of capital gains, those are taxed where you're resident. So if you qualify as a non-resident of the US, you wouldn't be reporting the capital gains here. And then interest and some of the other items are really determined on where the source of the income is.
And not to give you any kind of ideas, but we have clients that live in both countries more or less for more than 10 years, mostly in the US, and still claim they're not US residents. But well, everybody has a different threshold, whether they can still sleep at night or not. So.
Exactly.
So,
and now let's say a very common issue is, especially in this area, when you get stock options from a company. And normally people who earn this kind of salary sometimes are very mobile. So let's say our single Hans now works for a German company since 2011 and he receives 100 shares not publicly traded, for 150 euros each, and he has the right to sell them after 8 years. And now the market price is 200, and of course there's a difference, and this difference is a taxable benefit, and he has to deal with this. And now he has worked in 3 countries during this time, and to make it very easy, so he's worked in Germany from 2011 until 2013, in the UK from 14 to 15, and the remaining years from 2015 onwards in the US. And now what will happen after 8 years when he's going to execute his stock options? Which country has the right to tax this? So to simplify this, Germany gets 3/8 of this, the UK 2/8, and the US 3/8. And seriously, that means you have left another jurisdiction. You might not even think about this anymore, but you have a tax obligation in one of these countries. And even when you pay your taxes, let's say full in the US or full in Germany whatsoever, if it ever comes up, you still have then to pay your taxes in the UK. So, and again, it's about scaring people, of course, and giving solutions. So then simply make sure that you ask your advisor, whoever does the payroll, that this is going to be treated correctly.
Yeah, and the equity awards, we found that individuals aren't aware, because you can have left the U.S. and no longer have any ties with the company, and you're a non-resident, and that income is still taxable to the U.S. Now, if you receive equity awards, let's say even if it was earned almost all entirely before you came here, but you vested or exercised equity after you moved here and became a resident, that's going to be entirely taxable as a resident. Now, you might be able to get credits based on the sourcing of the income, but it will be entirely taxable if you're considered a resident.
And to make it a little bit more fun, it is also different when are you going to be taxed about this. So Germany only taxes the moment you execute. Whatever is going to be promised to you, we don't care. The moment you execute your stock options, you're going to be taxed on this. But I think there are certain exceptions in the US when you're going to be taxed on this.
Yeah, for stock options, you're taxed at exercise. So if you could have a vesting period of 3 or 4, whatever the period is, but it's at the point in time where you exercise the stock options, the difference between your purchase price and or your discounted purchase price and the fair market value is going to be the amount that becomes taxable to you upon exercise. And if you exercise in sale, you don't have any capital gains issues. If you exercise and hold, then there's another point in taxation at the time that you sell the shares.
So then the next thing is, sometimes people retire, get fired, or whatever happens in life. So, and now let's say Hans again still a German citizen, has been working for a German company, and he leaves the company in 2016. He receives additional payment, what happens quite often, and he goes back to Germany. And now we really have to ask the question, what is this compensation for? Let's say, who is allowed to tax this now? The country of employment, the US, is it now Germany because he lives here? And then we really have to figure out what is the reason for this payment. Is it a loss of income? Is it a part of pension? Is it a non-compete clause? And this all triggers a different solution from the tax code. Want to add to this?
Yes, I think there's another slide.
Yeah. Okay. I mentioned that already.
Yeah, and when you were looking at severance payments, there are different components that you have to look at. Whether the severance payment is a bonus for prior year's work, it's taxable based upon where you were working. If it's a payment for a non-compete clause or for a year's worth of salary, that's based on future service and sourced based upon those rules. You're also determined about when you're a resident or non-resident. If you leave the U.S. and get paid severance after you've gone and become a non-resident, then only the portion that we say is U.S. sourced is going to be subject to tax in the U.S. If it's a forward-looking non-compete clause or a year's worth of compensation for the future, then it wouldn't be taxable at all in the U.S. If you're looking at a severance payment, that's a payment recognizing your service period with the company, it could be taxed based upon your whole service period.
So what we're trying to say here, normally these are large payments, and when you know you get an amount like this, make sure you plan properly. What are your plans, and talk to someone who knows about the tax laws, not only in the current country, but also the country where you want to move to, where this has to be taxed, because this can have very unpleasant surprises. But again, it's not rocket science, everything can be planned, but only bear in mind, I get an enormous amount of money and I'm losing my job or giving up my job. How shall I plan this that I can keep most of the money?
And generally, when you look at these types of payments, you're going to usually pay tax at the higher of the two countries, and there's operations through treaty or credits to offset the liability. Now, where you can really be hurt substantially is if someplace like the UK that has a significant portion of severance payments are garden leave and non-taxable, which is completely different than the way the US treats it. The entire amount would be taxable here.
And the next thing, when you think, well, I figured it out, that's a double taxation agreement, how it works with the US or how it works with Austria. Every double taxation agreement is different. And everyone has a different regulation about this. So this means you really have to look into every double taxation agreement with every country, how this is going to be treated. And they're also kind of dynamic, so that means they're going to change every couple of years.
Right, I mean the worst scenario is, you have someone who had a year's worth of service in the U.S. and they get paid a payment before they left the country, before they left U.S. So the entire amount's taxable here, even though there's not tax credits or it wouldn't have been taxable in their home country.
So, and what also happens after he leaves the company, he receives his additional payment, and neither US nor Germany is something he fancies, so he simply decides to move to Spain. And now you will find out which country is going to tax this. When is it going to be paid? While he's still residing in the US or while he's residing in Spain? So then we have a third country that plays a role in this. And again, make sure you get proper consulting before you receive the payment or agree on anything. So now we say he still works for the German company in Palo Alto. He has dual citizenship now. He leaves the company in 2016, receives this additional payment, and then no matter what happens, you can elaborate on this. In the US, he will pay taxes on this anyhow because he's a US citizen now.
That's right, yeah, as a US citizen, you're going to be taxed on the entire amount. If any portion is subject to tax in another jurisdiction, you can take credits to offset the US liability, so you should avoid double taxation, but in that scenario, you're going to pay tax at the US rate.
But even when you pay the taxes in the US, this does not mean that you do not have to pay taxes in another jurisdiction about this when you leave the country.
Right.
So now we come to pensions and distributions and contributions. So.
Yeah, for pensions, basically, we generally look to the treaties, and particularly the German-U.S. treaty as favorable treatment. And there's three different areas that we look at. First is your employee contributions. And when you make employee contributions, the German treaty allows you to treat those similar to that we do for the U.S. So you can make pre-tax contributions back to your home country in Germany, and it's treated just like a 401k or a pension plan. And that's not true in some other countries, but for Germany it works well. And any portion that your employer contributes on your behalf to a qualified pension plan, that's also going to be considered non-taxable income, just as if it was a qualified plan in the U.S. And again, other countries, you might have an element of compensation for the amount that employer contributes to your plan. And then you look at distributions, and generally, pension distributions are taxable where you're resident for qualified plans. So if you've come to the U.S., you're a permanent citizen here, or a citizen or a permanent resident here, and you're taking your pension distributions, they're going to be taxable where you're resident. And the same thing if you're a U.S. person and you've moved to Germany and not a citizen, then you're going to have the pension will be generally taxable in Germany when you take distributions.
So now Affordable Care Act, this is...
Right. We just want to mention that because obviously that's a fairly new legislation that hopefully you're all familiar with in the meantime. The what is new now is that even though you may work for a company that is not required to provide health insurance to you because there's less than 50 employees in the company, you yourself as an individual, if you're a resident of the United States, you're liable and you're responsible to have health insurance, and you have to declare and certify this on your tax return that you had a full year's worth of coverage with the healthcare legislation. So that means you and your family, not just yourself. Now this is only required, as I said, if you're a resident of the United States. If you're a non-resident for various reasons, right? If it's because you haven't spent 183 days here, or for example, if you are here on a J or an F visa, I don't know if that applies to anyone here. That means you're non-resident and you don't have to comply with the requirements. What that also means is, a lot of people come here, obviously, they're insured in Germany, maybe they're still in the, I want to say public health insurance law, just have like an additional foreign country health insurance. That, the general insurances, right, that you may have in Germany with whatever, the Barmerversicherung, AOK, all these, health insurance companies, they do, I want to say formally, not comply with the United States healthcare legislation. And you have to check before you certify on your return that your healthcare plan that you have, if it's not a US plan, actually complies with these laws. So that means, for a lot of individuals, they have health insurances that are, very, I want to say, they include almost everything, right? You have a very good healthcare plan. But that doesn't mean necessarily that it follows the legislation of the Affordable Care Act. So go back to your company, to your health insurance company, and see if they have checked if their plan or if your plan follows these rules. Like when the legislation came out, a lot of the firms had not done that, but we now see a lot of big European healthcare providers that actually actively write to their to people that are insured under their plan that they do qualify under the ACA, which, so you may have received that. But definitely do go back and check if your healthcare plan qualifies under the rules, and you can certify in your return that you have the full coverage.
Yeah, one of the exemptions is to have an expatriate type health program. So many employers that send people around the world have expatriate health plans that qualify. But as Kristin said, the national health insurance does not qualify. The only country that I think has qualified to date is Switzerland. UK or Canada, Germany, none of those have qualified, at least at the last time I looked it up.
Because we have such a bad healthcare system, I know. So. So now we come to expatriation tax. That means when you have recourse, especially for Germans who move over here, this is always a big issue. So I think you start first with the US. May I see your slide?
Greg talked about individuals that have a green card, and if you have a green card and you've been in the U.S. in 8 of the last 15 years, and that's any part of 8 years, so it could be as little as 6 years and a month before and after, then you may be subject to expatriation tax. And expatriation tax is a system whereby you have a deemed sale of all of your assets as you leave the country. And this is assets around the world. So you're treated as if you've sold everything, pay capital gains tax on it, and that's your price for giving up citizenship after being a long-term resident. You're only subject to this. First, you have to meet that 8 of 15-year rule, but you have to have more than 2 million of assets around the world, and your average tax liability is greater 2 million or your average tax liability is $160,000 over the last 5 years. So what this is, I guess the reasoning behind this is that you're seen as expatriating for tax avoidance purposes. And not only do you have issues with regards to having this deemed sale of your assets as you give up your green card, but there's also ongoing issues being a covered expatriate if you have any income from U.S. sources, and if you leave assets to any U.S. citizens. There's a special inheritance tax that's imposed on the recipient of these assets.
So in Germany, it is, no matter how long you have lived or stayed in Germany, when you have when you have had tax liability or tax resident for the last 10 years and you own more than 1% shares in a corporation or a company, but not like a partnership, it has to be a corporation, and you earn more than 1%, then you might be subject of expatriation tax. There are ways to avoid this, or at least that you can only make a deposit. You do not have to pay the taxes, but everybody who owns more than 1% in a GmbH or AG, something like this, should talk to the tax consultants how to deal with this issue prior to leaving the country.
All right, that's a section that is not necessarily related to a tax liability that you have, but I think it's a very, very important section that a lot of people miss. And you know, that people that have lived here in the United States for many, many years, but they have never followed the informational reporting rules. Just as a general, as a general remark, the big differences I think also between the German and the U.S. tax system is in the United States, you declare on your tax return not only what your income is, but also your tax liability, right? And so the process is, you file your return, it's probably filed electronically, it is scanned in the system at the IRS, there's probably some, your tax liability is recalculated, your income is matched with reports, with your W-2, with your 1099s, and then that's it, typically, right? If you're being audited, it's because, it's just, you were selected as part of a statistical process, etc., but the chances are typically pretty low, right? So, but if you actually have underreported your taxes, the interest and penalties on that underreporting or not reporting any income are very, very severe. Now, that's one thing, right? Interest and penalties, that can be pretty high. However, if you miss any of these informational form reportings, the penalties are very severe. Meaning, if you file, a form, one of those informational forms that I'm going to talk about late or not at all, the penalties start at $10,000. And when I started working here in the U.S. 14 years ago, those penalties existed. They were written into the law, but they were very rarely actually implemented, and they were very rarely assessed. But throughout the years, the IRS has updated their systems, their computer systems, and we see a lot more of those penalties now actually being assessed. And oftentimes, although we negotiate, I want to say, with the IRS sometimes for years, they're not being abated. So these are things that you have to take very seriously, and and follow. I think that's as important or more important than filing your tax returns on time and correctly. The one is, as I said, hopefully you're aware of all of that. That is your financial state, your financial assets. If you still have accounts in a foreign country or own part of a company, if you own part of a German GmbH or some German partnership, you may have to report these assets on your tax return or separately on what we call the foreign bank account report, the FBARs. I hope that you all know that's a separate report. It is due every year in June, at the end of June, at least through now. Those things will change next year. They will actually be due at the same time as your tax returns are due and will be extendable. So there's a change in legislation, but it's very important to file these forms. You have to file a foreign bank account report if you have, at any time throughout the year, more than $10,000 on foreign accounts Meaning if you have 5 accounts and each one has $2,000 on it, you have to report all 5 accounts. Accounts means, bank accounts, obviously. It means, security accounts, but it also means your life insurance. So if you have a, old traditional Kapitallebensversicherung, that's what also needs to be reported on this FBAR. And so typically, many people miss that part, but that's what actually gets you over the threshold of, what you have. So that's very important to report that as well. It is getting more important to report that because you may have heard of a new legislation that was signed into law, actually, that the United States signed bilaterally with a lot of countries in the world, which we call FATCA. It's a Foreign Account Compliance Act, and that means Germany signed that together with the United States. And so now the German banks actually have to report your, bank assets and your accounts to the United States. And so obviously it's just a matter of time for the Treasury here to be able to process this information and to contact you that you have not reported your foreign bank account report. So this is to be taken really seriously.
And as far as I've learned, up from the year 2017, this reporting should be flawless from Germany to the US, and everybody knows the Germans are very diligent with this, so please be prepared. Up from 2017, everything you own in Germany under those rules will be reported to the US.
Yeah, and you probably, if you have any accounts in in foreign countries that are part of this act, oftentimes when the banks will contact you annually and ask you specifically if you're a U.S. citizen, and if you are a U.S. citizen, then you're required to file a W-8 if you're a non-resident of the U.S. or a W-9 if you're a resident.
And maybe what we didn't touch when we come, let's say, to how to administer this, it always has to be the highest amount on any given day during the year. So that means you really have to go to the bank statements and check when was the highest amount. When you really want to put this to the top, you can even say what was it within any given day, even when there have been some kind of big movement. So this is really something you have to check very thoroughly, and especially when you have equities account in Germany, you literally would have to track them every day. What is the amount and what is the amount I have to report about this account?
What you also need to report is on your tax, or as part of your tax return, if you receive gifts from a person abroad, gifts in excess of $100,000 if you receive them from an individual, and a little bit over $15,000 if you receive it from a corporation or from another entity. That means, not just if you receive cash gifts, but if you receive gifts, of real estate or anything that is worth more than $100,000. That doesn't necessarily mean that you're being taxed on this gift, right? We'll, I think, touch on that a little later. But you do have to report that you received this cash, and then obviously if you have income out of whatever gift you get, that's also reportable here in the United States. Again, here for this, if you don't report this, the penalties are very severe. As said, starting at $10,000, and so make sure that whenever you get something in that amount, to report that on your tax returns as well.
And to lighten up this with a practical example, we had a gentleman who contacted us. It started out he simply wanted to do his will because he got some properties in his name in Germany, and now he got married and he wanted to get his affairs in order in case anything happened to him. And then we found out at the first moment that he had real estate in Germany with an income for more than 200,000 euros per year, never reported to the US, and it was under administration in Germany by a colleague of ours, and he only granted him every year 3,500 euros out of the 200,000. So, and then from a German perspective, everything was done totally correctly, but neither the inheritance, or let's say the passing on, nor the income has ever been reported to the US. So we met with a tax advisor in Hamburg, and he said bluntly to me, the US is not my problem. I said, yes, he said, but you are the administrator of the entire estate from the grandfather passed onto our client. And did you ever tell him he should seek help for this? And I really believed our client. He was totally unaware of this. So that means he owns his properties for 20 years, made every year 200,000 euros, which was never reported to the US. And all that he has received this has never been reported to the US. And the value was around 5 million euros, a little bit more than 100,000. And I can tell you we contacted 3 firms in the US. Nobody wanted to touch this. And thanks God Kristin's firm did. We solved it. And I still remember the last meeting, not the last meeting, but it's the final meeting in this issue. I said, look, I have a good and a bad news for you. We solved everything, but before you leave, I would like to have a check of $500,000. They were totally happy to pay this because it was simply done. So what I'm saying is, so many people are really unaware of this, and this can have really severe consequences. And frankly, we all were happy when the 3-year statute of limitation passed and nothing happened.
One additional thing that I want to mention. So, there's different, as I said, different informational reportings that you have to do, which is the foreign bank account report separate from your tax return. If you have, this gifts that you receive, or you have transactions with a foreign trust, it's a form called, just see here, 3520 that you report with your tax return. If you, for example, own, the assets that need to be reported on your foreign bank account report may also need to be reported on a separate form together with your tax return again. So it's kind of a duplicate reporting that you have to do. But you also have to report there, if you have ownership in, in entities. And that's what we see a lot. That's what people are not aware of. If you own a foreign entity, meaning a foreign corporation or a foreign partnership, and you own more than 10%, that's the time when you need to tell your tax advisor or call us that, you have this investment, because you do have to file a separate form on your tax return. Which again, if you don't file it, there's a $10,000 penalty. It's, if you own ownership in a foreign corporation or foreign partnership, you do have to report the balance sheet and the income statement of the entity, and have to various other disclosures. In addition to that, you have to assess if there's income that you have to report on US tax return. Although you have a foreign corporation and it's a separate entity that is taxable in Germany, you may have to report, under certain circumstances, income out of these entities. So, that's one of the things, as I said, that a lot of people actually have, right? They are maybe, part of a family, they move to the US for a while, become residents, and they don't report this. So, that's a very important other thing to do. Now, what we don't have on the slides here, if you have not filed these informational forms, or if you have not filed foreign bank account reports, there is still at this time certain amnesty programs that can be taken advantage of. That means, you have to come forward and declare, for, depending how many years, 6, 7 years, or maybe just the last 3 years, depending on what kind of amnesty you qualify for. You have to come forward and report all of your income on your tax return if you haven't done that, and declare these accounts. I'm saying if you have not done that, or if you know somebody who maybe, is not aware of that, tell them to do that as soon as possible, because we do know from the IRS, there's a lot of people that came forward in the last few years in reporting, these accounts and these assets, but that's probably will end. I mean, these amnesty programs will probably end. The government overall, the information is is pretty aggressive. So they say, if somebody doesn't know about it now, they don't have, they're not how to say, it's not that they don't know about it, they don't want to know about that. And at that time, if you cannot prove that you were not willful, it's a criminal offense, and the penalties are going to be very severe, or people go to jail for that. So it's very important to take these things very seriously, because that's one of the things where negotiating with the government does not work very well. One other thing that has come up recently, and it's not a tax issue, I just want to mention that, because they now also start to threaten with a $10,000 penalty. That is, the Department of Commerce now also wants to have, reported if people do investments here or they own, entities here in the United States. It's probably comparable to the Statistische Bundesamt in Germany. So they just want to have that information, and there's certain reportings that you have to do. So, as I said, if you're a U.S. person, meaning you are a citizen or a tax resident here in the United States, and you do have investments, that go to that website, find out if you have any reportings that are not tax reportings, as I said, but that you may have to do. Sometimes you're being contacted, or your company may be contacted to file these forms, but nevertheless, as I said, even if you're not contacted, you may have the requirements. So check this out as well.
So, and then, just for mentioning this might have gone unnoticed, especially with people who live a little bit longer. We in Europe have a new inheritance law. It's not inheritance tax law, this hasn't changed, it's just inheritance law. None of us is going to advise on this. The basic rule is that now always the laws of the countries are applicable where you are residing and not where you are from. Only check with your legal counsel whether you have a will still in Europe, whether this is still valid, or whether you have to change this or to work on this, or whether this has impacted you in any way. So that's the advice we are giving on this, that you please check this. So, and now the big difference between inheritance tax in the US and Germany is the US taxes the asset, the estate itself, and Germany always taxes the beneficiary. It's a big difference whether you just tax the estate which is left or the individual who receives this.
Right, so just as an example, I get, phone calls on a regular basis where somebody, lives in the United States, is a US person, right, is a tax resident here, and they get, for example, I don't know, $200,000 in cash from their grandmother that lives in Germany. Right, and so under German understanding, under German law, the heir would be taxable. So a lot of people think that they're taxable with that, for that gift, which they're not as a U.S. person on the U.S. tax law. They're taxable on the income that comes, if it's invested in something. But if it's cash, then that's not necessarily taxed here in the United States. However, for example, if you are gifted or if you inherit a condo here in San Francisco, then that's a different thing. It's a U.S. asset, right? So that's a completely different situation. So just be aware of the different tax systems, and when that happens, just look for help and look for advice.
So now we have an example. One example is two variations. You might think it's all the same, but please pay close attention to this. So we still have Hans. He's living now here for 30 years with his wife in Berkeley, and his mother Gerda, German citizen, passes away in Munich, and she has a couple of buildings which she leaves to her son, and she has a second home at Tahoe. So what happens? Let's say once we have calculated the tax base, she leaves her son 1.4 million euros. Tax allowance, because he's the son, is 400,000. Taxable amount is 1 million, and the tax on this is 190,000 euros. So, why is this? Because the German inheritance tax law ties it to where someone lives, either the heir or the one who receives this. If either one lives in Germany, we have an unlimited tax liability at this moment. So now, little variation, they're still living in Berkeley, and now in 2012 the mother moves to the US, and she lives permanently here, and then she dies in 2015. She still has the same assets, same result, although she does not live in Germany anymore. So now we come to the next example, still the same situation. Now she dies in 2020, in the Bay Area, still the same assets. And whoops, now we pay a little bit more in inheritance tax. And why is this? When you have lived in Germany for 10 years prior to leaving the country, you have an extended unlimited tax liability when it comes to inheritance tax, which still deems that you are still residing in Germany, and then you have to pay the full inheritance tax in Germany, but you get all the allowances. This was in the double taxation agreement for your protection when you leave the country, because normally the laws are here way more higher, let's say the tax rate is way more higher. So when you really see that your mother is going to die in 2020 with this situation, put her back in a plane, rent it if necessary, because it starts to renew once you touch German soil. And let's say for this difference in money you can rent every private jet, but ship her back to Germany. It might be her dying wish anyway to be buried in Germany. So, and then it saves you a lot of money. Again, you really have to be aware of this. So that's, I think, explained now what happened. And normally it is just 5 years extended unlimited tax liability, but with the US double taxation agreement it is 10 years. And we also should mention, I think nearly every country, at least Germany and US, we have double taxation agreements when it comes to income taxes, nearly every country in the world. but there I think there's only 10 or 12 when it comes to inheritance tax. And I think, help me out on this, even inheritances and gifts are being treated differently under this double taxation agreement regarding inheritance tax. So if there are substantial assets, it is also very vital that you start planning. And I think most Germans who live here might have some family, money, properties whatsoever. So please make sure that you deal with this correctly.
Right. I mean, just as a more general comment, in the U.S., and that's important for a lot of people. A lot of people ask us, I have a green card now, should I become a citizen, right? And so for income tax purposes, it really doesn't make much of a difference, right? Because you're treated as an American already, you're taxable with your worldwide income already. It does make a difference, though, potentially for your estate taxes, right? And a lot of people don't want to think about that. A lot of people do not think about that. But if you're a U.S. citizen, you are, with a few exceptions, you are taxable with your worldwide estate here in the United States. Now, at this time, we still have a very generous exemption, right? It's over $5 million, and a lot of people don't reach that. But this will probably change, right? We don't know what's going to happen in the future with regards to that. So that's one of the things that you need to consider if you want to become a citizen. Does that make a difference for you from an estate tax perspective? We do have a treaty, the U.S. with Germany for estate taxes, and it's pretty clearly regulated what will be taxed where and when. It's pretty complicated. You will probably not be surprised, but I mean that's something that that's really plannable. I want to say that can be planned, and what you should not, the mistake you should not make is assume that because you are something for income tax purposes that the situation is similar for estate tax purposes. A U.S. person, or the definition of where you are resident for estate tax purposes and for income tax purposes is different. So just because you are a U.S. person for income tax doesn't mean that you're a U.S. person for estate taxes, and that means you may not have the big exemption amounts, right? So that could be an advantage and a disadvantage, because that means that you may have a very low exemption amount, which is only about $60,000. So that can make a big difference.
Yeah, for example, there's an unlimited marital deduction for U.S. citizens, but if one of the persons is a non-resident, then the marital deduction is $125,000 or something like that. So that's obviously a huge difference.
And as a personal remark, for Germans who just moved here and are not US citizens, but just green card holders or living here on a visa, make sure you have a good trust attorney and talk to them seriously what you can do to protect your assets. This is not so expensive, but make sure you have someone who takes care about this. And as a closing remark, you have seen me touch a lot of issues. Rescue consulting is way more expensive than planning this properly. So, thank you for your attention.
Thank you all. Yeah. So if there's any general questions that you want to lob up at us for a few minutes, we'll take them.